Hey everyone, welcome back to Corporate Decoder. Today we are diving into a treasure hunt with A-Mark Precious Metals, but instead of gold, we're digging into their financial report. Get ready for a roller coaster, because this report has some twists and turns you won't see coming. We are decoding their recent 8K filing. It's all about debt guarantees and a web of subsidiaries. In short, A-Mark got some of its subsidiaries to promise to pay back their loans if they can't. A-Mark Precious Metals Inc. just brought some of its recently acquired companies into its existing loan agreement. 5 of their direct and indirect subsidiaries now have a legal obligation to guarantee the company's debt. Think of it as adding more players to a team, all agreeing to share the responsibility for a big loan. This agreement is with CIBC Bank USA, who is acting as the administrative agent for the lenders. Basically, CIBC is the middleman making sure everyone plays nice with the money. This happened on April 25, 2025. This all ties back to A-Mark's existing credit agreement, which dates back to December 2021 and has already been amended 12 times, so it has been changed a lot of times already. This credit agreement provides A-Mark with a revolving credit facility. A revolving credit facility is like a credit card for a company. They can borrow money, pay it back, and borrow again as needed. And that's all there is to it. The document is required to have a 100 on or for exhibit, which is in XBRL format. So what does this all mean? On the surface, it seems like A-Mark is just tightening its financial ship, getting everyone on board to secure its debt. But digging deeper, there might be a few things to consider. A-Mark Precious Metals is in the business of buying, selling, and storing precious metals. This market can be very up and down depending on the economy and investor sentiment or what people think and feel about the economy. By having these subsidiaries guarantee the debt, A-Mark is spreading the risk. It's like saying, if we can't pay, these other parts of our company will chip in. This could be good because it makes the loan look less risky to the bank, which might mean better terms for A-Mark in the long run. However, it also means that if A-Mark struggles, these subsidiaries could also be dragged down with it. It's a bit like tying everyone together in a race. If one falls, it affects everyone else. This move could also signal a couple of things about A-Mark's financial strategy. Maybe they're planning some big moves or acquisitions and want to make sure they have enough credit available. Or it could mean that they're feeling a bit of pressure and want to shore up their financial position or make it more strong. Now for the risks. The biggest risk here is that if A-Mark can't meet its debt obligations, these subsidiaries could be on the hook, potentially impacting their own operations and financial health. It's like asking your friends to co-sign a loan. If you can't pay, they're responsible. Also, it raises the question, why did these particular subsidiaries get chosen? Are they the most profitable or the most stable? The report doesn't say. On the flip side, this could be an opportunity. If A-Mark uses this credit wisely to grow and expand, everyone benefits. The subsidiaries could see increased business and the company as a whole becomes more stable and profitable. In conclusion, this 8K filing is a peek behind the curtain of A-Mark's financial strategy. It shows a company that is actively managing its debt and spreading risk across its subsidiaries. Whether this is a sign of strength or a potential weakness depends on how well A-Mark manages its business and navigates the volatile precious metals market. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. What are your thoughts on A-Mark's move? Let me know in the comments below.